Good day. Today we will be talking about the impact of Fed's decision on commodity prices. For this topic, we will be interviewing Mr. JJ from Thailand. Welcome, JJ. Let's start with what commodities are, and if you could elaborate on that, please.
Okay, the commodity is the tradable and widely used for the industrial world, and you can see we have a lot of commodity like oil, gold, and agriculture product. And as you can see here on the bottom right of the presentation, this is the rubber, which is very famous on the Southeast Asia.
Okay, and could you also tell me what the Fed is and what is that they do?
Yeah, sure. Fed is the central bank and monetary authority of the US. They have to provide a safe, flexible, and stable financial system. At the central bank, they have to regulate their commercial bank also, and they have to maintain the financial services. And the FOMC is the group of the people under the Fed that make the decision how to apply the policy and what policy have to apply. And as you can see here, there's a logo and the chairman of the Fed, Jerome Powell, he is the head of meetings and making the decision.
Okay. What is that exactly? You mentioned monetary policy. How do they conduct that?
Okay, when we talk about the policy, most of the time that FOMC have the meeting, they coming out with the QE decision. The QE is the quantitative easing that aim for expand the economy. On the other hand, if they want to reduce or contract the economy, they can do the quantitative tightening. But the quantitative easing, after this that we call is QE. When they do QE, they aim for the expansion, and that will cause the commodity price to rise. And how it works? When you do the QE, the central bank, Fed, have to buy the T security from the commercial bank. It means that the commercial bank will have more money to lend. We have more opportunity to lend out. And then it happens, the money supply in the market is increasing, which causes the lower interest rate. When you have the lower interest rate, the lower cost of funding in the terms of the borrower can be consumer or can be the investment. Okay, and then people we have to think that if you put the money in the deposit, will provide very low return. So they have to seeking for the better investment, and mostly they shift the money from bond and deposit in the bank to the stock and commodities. And this is why this can cause the increasing in commodity price.
Interesting. So tell me more about the decision-making process. How does it work in real life?
Okay, Fed will have the FOMC meeting maybe twice a month or can be one time per 2 months. And in the meeting, they will evaluate the past policy and coming up with the new policy, and they apply into the market, and they have to observe the market, how market react with that policy. Then they coming out with the evaluation of the policy again, and then they have the meeting, and it's coming in this way all along. And you can see that we have the example from 2000 to 2021, how the Fed decision affect the commodity price on the subprime crisis. You can see that the sharply drop on the crisis. So Fed have to stimulate the market. They put a lot of QE. And when the time comes on the first quarter of 2010, all of the index fall again. So after they stop using the QE, they have to start using the QE again on the third quarter of 2010. After that, they have to evaluate, and they see that the commodity price is going up, but the inflation rate not reach the target. The core PCE in this term is the Fed tools that they have to compute and determine their inflation. So they set the target on this. So they try to remain the QE because they have to reach the target, the inflation target. And then on the second quarter of 2011, they stop using QE because it's going up too high. That caused like the commodity price drop, but the PCE, the inflation is remain going up. And then we move to the COVID-19 pandemic. This is quite different from the last time. The commodity price and the inflation dropped significantly from the lockdown, but Fed tried to stimulate the inflation and stimulate the market. They're using a lot of QE to improve the market situation, and they have to use it and evaluate it very, very carefully because like they don't want this to be the crisis anymore.
Okay, so you mentioned two important seasons, the subprime crisis and the COVID-19 pandemic. What are the biggest differences between them?
Yeah, from the subprime, they aggressive react to the market. They try to push the market up. So when it happened, they will facing the fluctuating on the market and inflation also. But at that time, because of the crisis, the recovery rate is very low. So that is the reason why they have to push a very, very strong aggressive policy to stimulate the market. So they have to apply and stop every quarter or every 2 months of the QE. But in this time for the COVID, they have more passive policy in the market because the market recover very fast within a quarter after the very sharply plunk in March 2020. So this is why they start using QE at that time and remain the QE since like the first quarter of 2020.
Okay, well, so we are still under the COVID-19 pandemic season, and we see a lot of changes in the policies that the Fed is applying. So could you like give us a heads up on what could be happening to commodity prices by the end of this year?
Yep. From the timeline for this year, 2021, on the first quarter, Fed mentioned about the inflation, the target inflation at 2%. Then if it's not reached 2% yet, they will starting to use QE and keep using it on. Then on the second quarter, they can see that the inflation go up really fast, faster than they expected, but still not reach the target. So they come up with still using the QE, but we have to take good care of it. Then move to the third quarter, they try to reduce the amount of the QE, but still using it. And they mentioned again that if on the fourth quarter, the inflation is reached the target, they might stop. And here on today, they coming out with they still using the QE, but they mentioned one thing that the target inflation is reached, but they still concerned with the economic condition on 22nd, so they still using the QE but lower amount. And here the expected in the QE and the Fed fund rate, which is the tools of the QE. You can see each dot represent each member of the FOMC members that they expected for the higher rate, which is lower QE, or not in the next year further. And they have optimistic, half of them think that they might increase the rate on 2022. So as we know before that the correlation between the commodity price and the QE is inward. So the probability increase to increasing the rate on 2022 is getting higher. It means that the Fed might reduce the QE, and that will cause you the lower in price of commodities. So my expectation for this quarter and maybe first quarter of 2022, it will be sideways up. It means that the price will move out within the range, but a bit going up movement because of the market and inflation. But we have some concern on the bubble of the commodity also and the high inflation. So we have to take good care of the market in order to see that we facing the high inflation or not.
Well, thank you so much, JJ. And thank you so much for the audience to be here.
Thank you.